Okay, so what is fixed income? Now, the fixed income basically refers to the debt markets. Now, an issuer of fixed income products may need to take out a loan for any reason. They can do this by selling bonds or similar securities in exchange for hard cash. Now, they do this in the fixed income market rather than going to a bank for a loan, as they're basically going to get a better deal. Now, the cash that they raise through the sale of the debt can then be used to fund anything from a large project to just helping with their business running costs. Now, the issuer of that debt then promises to pay the money back to the lender at a certain date in the future, and this will be known as the maturity. And at the same time, they're also going to agree to make regular payments, either in the form of fixed interest or in dividends back to the investor, and this part of the product is called the coupon. Now, the bond can start life by being auctioned, so the issuer of the debt can get a better deal when their debt is in high demand, or they can ensure that they get the best possible terms and conditions when their debt is less desirable. Now, government and corporate bonds are the most common types of fixed income products, and the maturity of that debt can range from very short term to decades long. As an example, the US federal government needs to fund Medicaid, Medicare, Social Security, the armed forces, and the US Treasury can issue things like 30-year US Treasury bonds, and they might come with a 1.25% interest rate. Now, an investor in that bond, for every $1,000 that they spend, the US Treasury will pay the investor interest, and based on the rate of 1.25% a year, for every $1,000 that you've invested, for 30 years, you're going to receive $12.50. At the end of the 30 years, the investor is then repaid every $1,000 that they invested, and they've also collected all of that coupon. Now, because the investment is fixed, and if you're an investor who prefers more conservative approaches, then you're going to use these markets for investing, as you can receive regular payments, but you don't also have to worry about price fluctuations in stock markets or interest rates on your currencies going up and down.